Banks are tightening their lending standards right now, and every time in the past they've done this, we have seen a correlating recession. Essentially, it's getting harder and harder to get a loan, and due to interest rates, if you do get the loan, it is more expensive. And every time we've seen bank tightening standards get to the levels they're at right now, we have seen a recession happen either soon or at the exact same time. Now, due to the fact that recessions are backwards looking, this could also mean we're in a recession right now, and it's just not official yet. If you don't know who I am, my name is Joe Brown. I run Heresy Financial University, where I teach active investors how to get higher returns with less risk by learning how markets work. If you're tired of losing money, link is in the description below. But you may also be thinking that correlation does not equal causation. So just because we see these tightening standards right now does not necessarily mean it will cause recession. In fact, it could be entirely backwards. The recession could cause those tightening standards themselves. And you're absolutely right. It doesn't actually matter though which way the correlation and causation goes. The fact of the matter is that the correlation is there. And given the fact that the tightening standards are where they're at right now, we're either in a recession or headed right into one. But again, that's only if this pattern keeps up. And we've seen some crazy correlations that have nothing to do with each other in the past, like sour cream consumption correlating to motorcycle deaths in non-collision transport accidents. Clearly, those things have nothing to do with each other, and just because they've been correlated in the past, there's no guarantee that that correlation will continue into the future. So is there any real concrete evidence, any reason why there would be a causal connection between banks tightening standards and a recession? Well, I'll let you answer that question after I explain how interest rates and money work in a purely free market system first, and then we'll look at the system that we have today. Imagine 1,000 years ago, you've got a little city and they're on a hard money standard. Everybody just has gold and silver coins that they use for money with each other. It's an isolated city, and so they don't have any global commerce. It's basically one isolated little economy. In this little city, there's farmers that produce all the food. There's people that make the clothes. There's builders that build the infrastructure. Basically, it's a self-contained economy, and there's people doing the roles to keep the functioning of the society going. You know that prices are simply information being communicated to the economy about how scarce or abundant something is. And so if the farmers who are growing the wheat just have a bad crop one year and they're not able to produce as much wheat, well, then some people are still going to need to buy just as much wheat. Maybe they're a baker and they need to make the bread for the society. And so they're going to have to pay a higher price. And other people are just going to say, hey, I'm not going to pay a higher price because I don't want the wheat that bad. Ultimately, though, you can only consume what has been produced. And so the price going up is information sent out about the scarcity of the wheat that year, that only half of it will be able to be consumed because it is more scarce. Nobody in the economy needs to know anything about the production of wheat, only the fact that the prices are higher, and that's enough to make educated, accurate decisions economically. Prices work the exact same way for money. Except with money, the price of money is going to be the interest rate, how much it costs you to acquire more money. So imagine in this economy, if every single person really good at budgeting, really good at personal finance, and they save up a little stack of gold coins, and everybody is saving, they're spending very little. In this situation, the savings pool is large because everybody has a ton of savings. And so me as a borrower, if I want to come in and borrow money from somebody, I can go to you and I can say, hey, I want to borrow money from you. What interest rate are you going to charge me? And maybe you say 3%. I'm going to look at somebody else and say, they're going to offer me 3%. What will you offer me? And maybe you say 2%. And I can go to all the savers who have money and bid them against each other and get the lowest rate possible because the savings pool is large. As a result, the interest rate is going to be very low. There's an abundance of money to draw on, pitting those lenders against each other, which reduces the incentive to hold on to those savings. So the incentive goes to spend, goes to borrow. Because capital is cheap. There's a big savings pool to draw on. It's time to grow, time to spend, time to invest. So let's say everybody flips and the pendulum starts swinging to the other side and everybody starts spending and borrowing. Well, then you're going to wind up in a situation where the savings pool is very low. There might only be one or two people who continue to be savers and everybody else has spent their money. Suddenly, for the borrowers, you're forced to go to only one or two people who have anything to lend. And now all the borrowers are bidding against each other for the one or two lenders. In that situation, lender can charge anything anything they want. They could charge 10, 12, 13, 14% because they've got all these borrowers wanting to borrow their money. The savings pool is scarce. Therefore, that money is more valuable. Now, I, as the only lender in town, I'm making a massive amount of money on my savings. And so now the incentive in the system is for everybody to start saving, because if you can start saving, get some extra money that you can loan out, you can make a great return along with me. So now that high cost of capital communicates to the economy: save, stop spending, pay down your debt. Become a saver, become a lender. There's not a lot of capital in the system. It's not a time to spend. It's not a time to take risks. There's not a cushion. Take risk off the table. And so in a completely free market economy, you're gonna have interest rates changing. They're gonna be communicating the scarcity or the abundance of the money. And that's gonna send information to economic actors about whether to save or spend, whether to borrow or lend. Now, as the pendulum is swinging from one side to another and interest rates are going up and down, obviously those are gonna be some times of growth and sometimes of very little growth. But if you want to see the boom bust cycle where things grow incredibly fast and then they crash and then they grow incredibly fast again and then they crash again, you need to have fractional reserve banking, where the money supply is elastic, it expands and contracts, and you have some actor artificially changing interest rates for the economy. Ultimately, interest rates are still going to be communicating scarcity or abundance of money and those signals to spend or save or lend or borrow to economic actors. But with fractional reserve banking, you have either a bank or a central bank with the ability to inject newly created money into the economy through debt. And so if the natural rate of interest at the moment, let's say, would be 3%, I, as a fractional reserve banker, can create money out of thin air as I loan it into existence. So I don't need to lend at 3% because any loan I make is pure profit because I'm loaning that money into existence. I'm not giving up purchasing power that I would have had otherwise. So I can loan at 2% and I'm still making money. On top of that, I attract more loan business because I'm undercutting all the other lenders. Now, the problem with this is that the money supply in real purchasing power terms is not actually as abundant as the information I'm communicating to the economy. I'm sending a false signal to go spend and to borrow. To push it to its extreme so you can really see, if the interest rate was naturally 20%, nobody would be borrowing, nobody would be spending, everybody would be saving, nobody would be investing, nobody would be taking risks. You'd be spending the bare minimum just to get by, and you'd be saving as much as possible to get that return. The savings pool would be rebuilt. If a central banker then comes in, prints money into existence by loaning it into existence at, let's say, 2%, well then everybody's gonna look at that like it's free money. They're gonna go get loans at 2%. They're gonna spend that money. Even though the purchasing power isn't changing, the actions change based on the false information they're receiving. This is going to cause out of control inflation as that new money bids up the prices of goods and services. There will be a misallocation of resources and malinvestments taking place. Essentially, people are just making incorrect economic decisions that will result in the destruction of wealth based on inaccurate information they received from the artificial interest rate. By the way, guys, I'm doing a silver giveaway, hundreds of dollars worth of silver for the Silver Symposium in Vegas from September 29th through October 1st. First place prize is getting this 10-ounce silver round. It's an Australian kookaburra, beautiful 10-ounce piece here. Second place gets this 10-ounce bar, not as pretty, but it's still 10 ounces of silver, so hundreds of dollars here. Third place prize gets this 1-ounce silver round. It's plated with gold, and it has this nice little Bitcoin design stamped into it, so pretty cool. So what do you have to do to get the prizes? Number one, you have to sign up for the event with the ticket link in the description below. Number two, you have to meet me in person. The first person who signed up with my link, who meets me there in Vegas, gets this first place prize. Second person to meet me gets the second place prize. Third person there to meet me gets the third place prize. So get your tickets in the link below. Just a couple of weeks left. Can't wait to see you there and give away these silver prizes. This is exactly what the Federal Reserve has always done in the United States from about 1940 through 1980, where we were in a long-term cycle of interest rates moving up, even though during certain times the interest rates moved down. And then from 1980 through the year 2020, we were in a long-term cycle of the Federal Reserve pushing interest rates down, even though there were some times where they did push interest rates higher. And now it looks like we've turned another corner into a long-term cycle with interest rates moving higher yet again for the next 40 years, even though there will be periods of time where they push interest rates lower. It's important to note that since the base interest rate in our economy is not a free market interest rate, it is imposed on the system by a central planner. It is not possible to know whether this interest rate is the natural interest rate. In other words, what it would be absent a central banker who participates in fractional reserve banking. Therefore, it makes it very difficult to make economic decisions that are accurate because you're basing them on the assumption that the rate of interest is correct. If the current interest rate is higher than the rate of interest would be otherwise, then people will be saving and lending too much, not borrowing enough, not spending enough, and economic activity will suffer as a result. However, if interest rates are lower than they would be otherwise, then people will spend too much and borrow too much, and you'll get a boom in prices, otherwise known as inflation, and you'll have a bust on the other side. Either way, you have economic damage that takes place as a result of somebody imposing an interest rate on the economy rather than letting it be free floating. And these bank tightening standards that we're seeing right now are a direct result of the Federal Reserve controlling or imposing their influence over interest rates. Back in 1990, when this measure exceeded 50, we saw a recession. Essentially, banks were saying, hey, interest rates are high. We're only going to loan out if we can loan it at a really high interest rate, and we're only going to loan it out to very qualified borrowers. It's very likely that at this time, the artificial interest rate imposed on the system was higher than it would have been otherwise. Therefore, economic activity suffered and we had a recession. Again, in 2001, when the measure of bank tightening standards exceeded 50, we got another recession. Again in 2008, again in 2020, and almost certainly again following 2023. Now, even if you don't buy the possibility that the current interest rate environment is too tight and higher than it would be outside of intervention, there's another reason why tight bank standards would cause a recession. Household debt is at an all-time high. Government debt is at an all-time high. And corporate debt is at an all-time high. When a system levers up and then suddenly you make new debt more expensive, the system only has two choices. Choice number one is take more of our income just to maintain the debt pile. Number two is take even more income than that to pay off the debt pile. Okay, there's a third option as well, which is default. All three of these are contractionary for an economy. Less income going around. And in the third example where you have default, well then that default is a asset on the bank's balance sheet that gets wiped out. And then that massively impacts the amount that they're able to lend out from there. So no matter how you look at it, when you ratchet up interest rates on an over-leveraged economy, that is going to cause a contraction. And unlike the correlation between sour cream consumption and motorcycle deaths, the correlation between bank tightening lending standards and recessions is most likely not spurious. And for more advanced training on investing and trading in order to take advantage of these cycles and not be at risk of collapse yourself, it's time to join Heresy Financial University. Link is in the description below. As always, thanks so much for watching. Have a great day.